Welcome back to Han Invest TV, where we uncover the brutal truth about the housing market and your financial future today. The American dream has always been defined by owning a home, a white picket fence, and a stable place to live. However, for many hardworking people today, that dream is rapidly becoming a financial nightmare due to soaring prices and hidden costs. We are going to expose the harsh reality of buying a home in the current economic landscape that nobody discusses. There is a massive difference between being approved for a loan by a bank and actually being able to afford it. Just because a lender says you can borrow the money does not mean you have the financial capacity to live comfortably. Banks primarily care about their own risk in ensuring you do not default immediately, rather than your long-term quality of life. They do not care if you have to skip vacations, struggle with grocery bills, or sacrifice your retirement savings to pay them. This brings us to the critical concept of debt-to-income ratio, which lenders use to decide your fate in the housing market. Financial experts recommend the 28% rule, but banks often push you towards a dangerous 43% threshold for approval. The conservative rule states your mortgage payment, including taxes and insurance, should never exceed 28% of your gross monthly income. However, lenders will often approve you up to 43% or higher, pushing you to the absolute brink of financial ruin. When you spend nearly half your income on housing, you have almost no margin for error when unexpected expenses inevitably arise. A broken car, a medical emergency, or a job loss becomes a catastrophic event rather than just a manageable inconvenience. Remember that banks look at your gross income before taxes, but you pay your mortgage with your net income after taxes. This discrepancy creates a false sense of security, leading many buyers to sign contracts they truly cannot afford in reality. Now we must discuss the silent wealth killers, known as hidden costs, which most first-time buyers completely ignore until too late. Property taxes are not fixed. They rise as your home value increases, meaning your monthly payment will go up over time. Homeowners insurance is skyrocketing across the country, especially in areas prone to natural disasters like floods, fires, and hurricanes. Climate change is causing insurance companies to raise premiums drastically, or in some cases, pull out of certain markets entirely. If you put down less than 20%, you are forced to pay private mortgage insurance, which protects the bank, not you. This is essentially burning money every single month, offering you absolutely no benefit or equity in the property you're paying for. Then there's maintenance, the most underestimated cost of all. When you rent, the landlord pays to fix the broken toilet. When you own, you are the landlord. A broken furnace, a leaking roof, or a cracked foundation is entirely your problem. A smart rule of thumb is to budget 1% of your home's value every single year just for routine maintenance costs. For a $500,000 home, that means saving $5,000 annually just to keep the house in working order. When you add these hidden costs to your mortgage, the monthly figure is often thousands of dollars higher than the sticker price. This brings us to the generational gap. Baby boomers often claimed they had it harder because interest rates were significantly higher. While rates were indeed higher in the 80s, home prices were only 3 times the average annual household income then. Today, the median home price is more than 5 times the median income, making the down payment barrier nearly impossible for many. Saving for a 20% down payment on a house that costs 5 times your salary takes significantly longer than before. Wages have not kept pace with asset inflation, creating a structural disadvantage that hard work alone cannot easily overcome for this generation. So what can you actually do? Is the dream dead? Nick Magliuli suggests 4 practical options for the average income earner. First, you can move to a lower cost of living area. This might mean leaving the big coastal cities for the Midwest. While this requires sacrificing your current location and social circle, it is the fastest way to align income with housing costs. Second, buy less house than you think you need. A starter condo or a smaller townhouse can get your foot in the door. You may have to compromise on space or yard size, but financial peace of mind is worth more than an extra empty bedroom. Third, consider house hacking. Buy a property with an extra unit or room and rent it out to cover your mortgage. This strategy requires becoming a landlord, which is work, but it can drastically reduce or even eliminate your monthly housing expense. Finally, you can continue renting. Renting is not throwing money away if you diligently invest the difference you save each month. The stock market has historically outperformed real estate appreciation in many periods, offering a viable path to wealth without home ownership headaches. There is no single right answer, but understanding these trade-offs is crucial for making a decision that fits your unique life goals. Do not let societal pressure or bank approvals dictate your financial happiness. You must define what a rich life means to you. Take the time to run the numbers yourself. Calculate the taxes, insurance, and maintenance to see the true cost of ownership. Your home should be a sanctuary that provides security, not a financial prison that keeps you awake at night with worry. The market is tough and the rules have changed, but with knowledge and discipline, you can still navigate this difficult landscape. Whether you buy now, wait for later, or choose to rent forever, make sure the choice supports your overall financial health. We hope this breakdown has given you the tools to look beyond the monthly payment and see the full financial picture. Remember, owning a home is a lifestyle choice as much as a financial one. Do not confuse the two when making your decision. Focus on building your net worth through diverse investments rather than putting every single dollar you have into four walls. Share this knowledge with your friends and family who might be feeling the pressure to buy before they're truly ready. Knowledge is the key to breaking free from the cycle of debt and making decisions that will benefit your future self. The housing market will always have cycles of ups and downs. Your strategy should be built on stability, not speculation. Prioritize your security first. A home is a wonderful asset, but only if it doesn't cost you your peace. Thank you for watching Han Invest TV. Make sure to subscribe for more financial insights and smart money management strategies. Let's dive deeper into the psychology of FOMO. Fear of missing out drives many to buy at the market peak. When you see others buying, you feel an urge to join in, fearing that if you wait, you'll never afford it. Mastering your emotions is just as important as mastering the math. Patience often pays off more than impulsive panic buying. History shows that real estate markets correct. Prices can stagnate or drop for years, leaving impulsive buyers underwater on their loans. Being underwater on a mortgage means you owe more than the home is worth, trapping you in the property for years. This lack of mobility can hurt your career earnings. Renters can easily move for a promotion. Homeowners are often stuck. Consider the opportunity cost of your down payment. That large sum of cash could be earning returns elsewhere in the economy. If you invested $100,000 down payment in the market, it could grow significantly over 30 years without effort. Meanwhile, a house requires constant cash injection just to maintain its value, lowering your actual net return on investment significantly. Economist Robert Shiller has famously shown that after adjusting for inflation, home prices have barely increased over the last century. Most of the price appreciation we see is simply inflation. You are not getting richer, your money is just worth less. Homeownership is essentially a forced savings account that requires part-time labor on weekends to maintain. It is not passive income. True passive investing allows you to grow wealth without physical labor. Real estate is a business that requires active management. Let's revisit house hacking. Renting out a spare bedroom can generate hundreds of dollars a month to offset your mortgage. Short-term rentals like Airbnb are another option, though they come with more work and regulatory risks in many cities. Always check local laws. Many cities are cracking down on short-term rentals, which could ruin your calculated financial projections. Another emerging trend is co-buying with friends or family. Pooling resources can help you afford a property in a better area. However, this requires a watertight legal agreement. What happens if one person wants to sell or loses their job?
Mixing money and friendship is risky. Ensure every worst-case scenario is documented and agreed upon before signing papers. Abandon the idea of the forever home. Your first home doesn't need to be the one you die in. Use the property ladder concept. Buy what you can afford now, build equity, and trade up later when your income grows. While you wait or save, focus intensely on improving your credit score. A better score means a lower interest rate. Even a 1% difference in interest rates can save you tens of thousands of dollars over the life of a loan. Pay down high-interest consumer debt first. Banks want to see a clean balance sheet before they trust you with a mortgage. Don't just accept the first offer from your bank. Shop around with multiple lenders to force them to compete for you. Consider using a mortgage broker who can search dozens of lenders to find the specific program that fits your financial situation. Be extremely cautious with adjustable rate mortgages. They may start low, but can explode higher if market rates rise in the future. A 30-year fixed-rate mortgage offers stability.